Uh, Good evening, everybody. My name again is King Gate Forex, and today we want to talk about risk management, right? Risk management. Risk management in the market basically means how to manage your capital or money in the market, right? How we can actually reduce our risk in the market so as to get enough profit or maximize our profit in the market. So, for me, there's a way I, I teach my students how to manage their risk, and so to do that, I we tend to have a kind of things that we need to know to have before we can actually manage our risk in the market, right? And this way, we will be able to journal our trades properly, right? You know what to expect at the end of every trade that you have taken, or at the end of the amount of trade you are willing to take in the market, and you can actually tell how much you are willing to risk to the market. Now, before that, right, we need to understand that we have to get our capital, right? We need to have our capital, and our capital can be different from each other depending on your pocket. Do you understand? Depending on your pocket, everybody is not equal. Excuse me, everybody is not equal, so everybody is going to have different capital, right? So for today's class, we are just going to be using an example, right? We're just uh, going to use $1,000 as an example, right? $1,000 as our capital, right? $1,000 as our capital. Excuse me. $1,000 as our capital, right? So we want to know our capital, we want to know our risk percentage, right? Our risk percentage, meaning that the money you are willing to risk per trade, right? So that risk percentage is actually, it depends on everybody. Some people will say 10%, some people will say 2%, 3%, depending on your risk appetite and how much you are willing to risk, that would not affect you emotionally, right? Something you can actually forfeit and not really bother about, right? Why do I say so? Because you need to be in your best behavior, or in your best sense, right? Best composure. You have to be in your best everything when it comes to what's trading the financial market or trading any kind of market, because you can actually trade the crypto market, synthetic markets, commodity markets, can trade any kind of market. So you need your risk percentage. Excuse me. You need to know your risk percentage. So you need to know your risk percentage. You need to know your risk percentage. So I'll be using 10% of my account, right? 10% of my account. Now, means that if I'm to risk 10% of my account, it means that it means if I'm to risk 10% of my account, it means that I'm going to be risking $100 per trade. That's 100 what? Dollars per trade. That's if I am to risk $100. If I'm to risk 10% of my account. So the next thing you want to know is our risk to reward ratio, right? You want to know our risk to reward ratio. Our risk to reward ratio can basically be anything, right? But for me, I teach two types of risk to reward ratio. I teach the flexible, and I teach, which can also be called the constant risk to reward ratio, and I teach the rigid, flexible rather, the inconstant what, risk to reward ratio, meaning that your risk to reward is what not constant, right? Excuse me. And I teach the constant, which is what the rigid risk to reward ratio, which is what constant, meaning that you are using the same or a constant, something that does not change, right? When you say constant, something that does not change, it stays at equilibrium. You are using the same risk to reward ratio for all your trades, right? The next thing we want to know our um, is our lot size, right? I'll be teaching you guys after this how to calculate your lot size, and we want to know how to our winning rate, right? We want to know our gross profit, right? Gross profit. We want to know our gross profit. We want to know our net profit, right? And we want to know our winning and our losses in the market, right? Our winnings and our losses in the market. So these things are the things that are very important for you to know, right? So let's now say, okay, how many $100 can we see in 1,000? We would say 10, right? Meaning that for us to actually exhaust our $1,000, we have to take what 10 trades. So we have to take 10 trades. So let's do it this way. We have to take 10 trades, right? So this is what we are jotting down our trades. Let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. So this numbering represents our number of trades, right? Meaning that for every trade we take, right, for every 10 trades, if you lose the whole 10 trades, rather, we can end up with exhausting our $1,000, right? For you, like, this is an example. Like I said, you can also change it to 5% or 4% or 2%, depending on your risk appetite. So the next thing is let's now say we lost our first 3 trades, right? Now, like I used to tell my students, if you have a working system, right, which is your setup, your trading setup, like be understanding the zones and everything and putting everything together so as to be able to get an edge in the market, right? Once you have a system, you shouldn't be changing that system, meaning that you have to continue using the same strategy on and on, winning or losing. Anytime you see a setup in the market, you have to make sure that you are following your setup. You are not changing your setup from one place to the other, right? That's consistency. Now let's now assume your setup. Let's now assume the market is like a coin tossing the coin, right? It means that if a coin has 2 sides, right, it means that it's either it is the coin moves, turns into the head, or it turns towards the tail side of the coin. Now they now ask you that you should choose for every toss you have to choose one side of the coin, right? Now there's something about the coin tossing, right? It means that if they are tossing the coin and you keep on changing from head to tail because of they tossed the coin the first time, you lost because you chose head and you brought tail, and you get, and you decided that you wanted to change from your head. Now you want to change it to tail, and they tossed it again, it changes it to the head. If you keep on changing from head to tail and tail to head, it is higher probability that you end up not winning any of the coin toss 10 times. But if you stick to the same side of the coin, which is, let's say you are choosing head all through the 10 toss, right, there's a higher probability that you are still going to gain 1 or 2 or 3 times. You get at least 3 side of 3 wins out of all the 10 toss that they are going to be giving to you, right? So it means that even if you toss the coin 10 times, it means that if you are choosing the same side of the coin, there's higher probability that you always come out profitable, or you come out with an head at least 3 times, right? Same thing applies to the forex market. Keep on doing the same thing. If you do it 10 times, it's not how out of those 10 you will not win 2 or 3 times out of that 10. And when it comes to that, like I said, let's say in these 10 trades we lost 7 and won just 3. So let's say the first 3 we lost the first 3, right? We won the next one, lost the next one, won, lost, and we won again, then we lose, then we won just 3. It means that for every loss we have in the market, that's our risk percentage, we are losing $100. So we lost what? 7 times, and we lost 7 times and we won 3 times, right? Now, looking at it, our loss is now what? About 700, right? That's loss is what? 700. That's 100 times what? 7, which is 700. Then our winning. Now let's go into flexible or rigid risk to reward. Now let's go for rigid risk to reward first. Now the rigid risk to reward that we're going to use, let's say assume that we want to be using 1:4 all through, meaning that we are risking $100 to get what? $400. So if that risk to reward means that for every loss you are having in the market, you are going to times it by what? The reward, which is 4, which is what? 100 times 4 for every trade you win. So we are going to be using 1:4 for our what? Flexible what? Risk to reward. For our flexible what? Risk to what? Reward. 1:4 for our flexible risk to what? Reward. Now means that for every winning here we have what? 400 all through. That's 100 times what? 4 is what? 400. So for our net gross profit we have what? 400 times 3. Gross profit will now be 400 times 3. So 400 times 3 is now what? 1200. 400 times 3 will now be 1200. Sorry, 1200 what? Dollars. 100 times 3 will be 1200 what? Dollars. Right? That's for our gross profit. Now we know that gross profit is all accumulated profits added all together without expenses, right? Without the expenses. So we'll now move ahead to our net profit. Net profit is, after we lost 7 trades, we have like indirectly have $300 left. So we need to balance up that $300 so as to give us back our main capital, which is $1,000. So we have to remove from our overall profit, which is 1,200, from our overall profit, which is 1,200, right, which is $1,200 minus, right, minus 700, right, minus 700 before we know how much we really earn in the market. Minus 700, which is going to give us actually what we earned, meaning that 700 is the money we removed so as to balance up our what? Capital, right? So minus 700 minus 700 which will be minus 700, which will be 2 minus 700, that will be about 500. So our profit in the market after removing the expenses, which is after balancing up our capital, is now what? 500. Yes, 500, I guess so. So this is our profit after we have balanced up our capital. So the capital is now intact, and $500 is actually how much you want actually milk out of the market. Now there is no difference between, the only difference between the flexible and the rigid risk reward is the risk reward is not constant, it's not the same. For the rigid I use 1:4 all through, meaning that we are risking $100 to gain $400. But for the flexible, it will be fluctuating. You can gain 400 now, you can gain 700 now, you can gain 1,100. So you can use 1:1, 1:4, 1:6, 1:11, depending on your what? strategy or what your setup is, what's presenting to you. So let's go into flexible risk to reward. Flexible risk to reward. So let's erase. We are going to still use the same format, but we just want to erase uh, the the gross profit and the net profit. Right, we delete all these ones. Right, gross profit and the net profit, we delete all these ones. All the other ones are all the same. We are still going to be winning 7, losing 7, and winning 3. So we want to know our gross profit now. So let's say for the flexible risk reward that we have here, which is flexible up here, right? Let's say the first trade we took that we won gave us 1:11, or the second one gave us 1 maybe 6. Then the third one gave us 1 let's say 3, right? Let's say the third one gave us 1:3, 1:3. So it means that we are still going to be losing 700 in the market, but this time for every win we have different what digits. For every win we have different what digits, right? We have different digits. So for our first win we said 1:11, meaning that your risk times 11, which is 100 times 11, which is 1100. So our first win is 1100. We are adding everything. Our gross profit will now be 1100 1100 plus the next trade is 1:6, which is 1 times 100 times 6, which is 600, plus 600 plus the next one, which is 1:3, that's time, plus 300, plus 300, right? So we had everything all together. We're going to add everything all together to give us our what gross profit. That's profit without what expenses or balancing up our capital, which is 1100 plus 600, that's 1700, plus 300, that's $2000. So for everything we end here on our gross profit is 2000 what dollars. $2000 on our what gross profit. Now how do we get our net profit? You already know 2000 minus what, so now be 2000 minus yes, 2000 minus how much? 2000 minus 700, which is we have lost 7 trades, so we have to remove it and balance up our capital. 2000 minus 700, minus 700, so that will be 1300 left. So 1300 after taking 10 trades is our what winning amount, right? That's the amount we actually milked out of the market. So we have 1300 left, $1300 left. We have $1300 left. So this $1300 is actually what we earned in the market, and our what capital is already balanced. Why? Because we have removed it from what the gross what profit, which is the profits we gained without what removing our capital. So that is how to calculate either your rigid risk reward or your what flexible what risk reward. Now our when it comes to uh when it comes to lot size, how do we calculate our lot size in respect to our um, risk, right? Risk. That is where we have to go into position size calculator. Go into what? Position size calculator. Position size calculator. So you click on Google and go to what? Position size calculator. The first one you see there, which is FX book, my FX book position size calculator. You click on what? The my FX book position size calculator. Then it will bring you to this page, right? Let's assume you can take anyone here, right? Like I said, for this one it is normal. Now we put here as 1000, which is our account balance or our account size, right? Which is our capital, and our risk ratio, which is 10%. Or you can change it to money, which is what? That's by clicking on swap to money, right? Which is $100. So if you want to use percentage, you can swap back to what? Percentage, right? Then stop loss, let's use our what? Our standard stop loss that we give in Abby, which is 20 pips stop loss, which for everybody is going to be different. Why? Because your setup is going to actually be the one that determine what? Your stop loss. Then the account size is intact, the trade size is intact, don't tamper with it, right? The only thing you need to do now is what? Click on what? Calculate. Right? Therefore, if you come down here now, you can see that your risk ratio is what? 10%, right? 10% of your account. Then you see the unit is 50,000. That's about the standard loss size. Then sizing is that's your lot size that you're going to be using, so as to lose just $100 per trade. So for you to lose $100 per trade, you need to use 0.35 if you are to use 20 pips what? Stop loss. And that is how to calculate your what? Lot size, right? So that will be all until we meet again in the future. Bye everybody.